Social Security is one of the most complex and confusing federal programs. With over 2,700 rules, it's no wonder that we're confused about when and how to start collecting and who to turn to for help. Welcome to Social Security Answers from the Experts, hosted by Martha Shedden. In this podcast series, Martha meets with professionals to provide you with the answers to questions about this most important financial decision. And now, here's your host, President and co-founder of the National Association of Registered Social Security Analysts, Martha Shedden.
Hello, everyone. Welcome to the show. I am your host, Martha Shedden, and today I am speaking with Kevin Robertson. Kevin is a Senior Vice President and Chief Revenue Officer at HSA Bank, where he's responsible for leading the growth strategy and organization of the bank. He has more than 20 years of experience in banking, insurance, and financial services, and is well-versed in issues related to Social Security, health savings accounts, benefits, and retirement. Kevin was also a self-employed large insurance business owner for 12 years and a FINRA registered representative and principal for 8 years. He is a recognized expert and well-known figure in the consumer-directed healthcare industry, especially for his legislative and regulatory efforts as Compliance Committee Chairman for the American Bankers Association, HSA Council. So welcome to the podcast, Kevin.
Thank you. Thank you for having me.
Let's start with the basics here for those in our listening audience who may not know or would like to know more details. What exactly is an HSA and who needs to know about them?
Sure. So HSA is just an acronym for Health Savings Account, which is really more than just a bank account that is used for health savings. It's actually part of a larger strategy around consumer-directed healthcare, or CDH for short. We love our acronyms in our industry.
Yeah.
And the concept around consumer-directed healthcare is empowering consumers to take more control of their healthcare decisioning. It is really the marriage of two different components. First of all, is a particular type of health plan that fits certain criteria that is defined by the IRS, that has a minimum deductible, maximum out-of-pocket, and meets certain provisions for cost containment, exposure, deductible, and such, right? And those are called high deductible health plans, although that name is kind of a misnomer today, because when they first brought HDHPs, or high deductible health plans, out, they were, typically higher than traditional plan counterparts. However, today, and really over the last 10 years, the traditional market deductibles and out-of-pockets have actually risen at a much higher rate than HDHPs. So today, the lines between what is a high deductible health plan and a traditional plan are significantly blurred. In fact, they pretty much don't exist.
Yeah.
And so that's really the first part of the puzzle. The second part of the puzzle, again, is the actual HSA itself. So when you hear somebody say, oh, I have an HSA, they're probably talking about the larger combination of the health plan and the health savings account. Now, focusing on the actual health savings account itself, it is the only triple tax advantaged instrument in existence today. What I mean when I say triple tax advantage is any money that is contributed to the HSA on the front end is done so on a tax-free basis. So any contributions that are made are either done, if they're done, for instance, through your employer in a payroll deduction, they're done on a tax-free or a pre-tax basis. If you make contributions on the back end as for instance, I'm just making a contribution and I take that and claim that on my taxes when I file my taxes with the IRS, that is a post-tax contribution. But again, it's done, I still get it as a tax deduction above the line when I file my taxes. So that's the first of the three tax advantages. The second tax advantage is while it's sitting in the HSA, earning interest, or if you're investing it and earning returns, it grows on a tax-deferred basis. And that's the second. And then the third and final tax advantage is when you go to take that money out. If you're using it for a qualified medical expense, it is tax-free. And if you are using it for something other than a qualified qualified medical expense, you do have to pay normal income tax on it. And if you're doing that prior to age 65, there is a 20% penalty on it. However, if you go back to the whole concept around health spending accounts, really what we're trying to do is by having a particular type of health plan that is paired with an HSA. What you're typically saying is, I'm going to take maybe a higher deductible than I traditionally would have done in a normal plan. I'm going to get some tax advantages for that higher exposure, but then it allows me to contribute to that HSA, grow balances, invest that over time, keep that from year to year, and use those dollars as I see fit in my healthcare spending and savings to better fit my lifestyle, not only today, but my future needs and my needs in retirement. The best way to think about this, and in doing so, I should lower my overall costs, and it also, maybe monies that I would have been putting towards plan premiums, I'm instead going to be putting those into an HSA and using those to help me grow, funds for other needs, my healthcare out-of-pocket expenses now in the future, or maybe I want to supplement retirement income if I don't ever use those for a health spending account or health expenses. Those are all your decisions to make. So that's the concept behind an HSA. I know that was a large answer, but it's really more simple. It's much more complex than just being, it's just a account for savings for healthcare.
Yes, you're certainly right about that. And I'm glad you described that triple tax benefit, because that was one of my questions for you. So I admit I think that I'm a bit ignorant, but I didn't realize that there could be an HSA bank. So does this mean that all the accounts at the bank are HSA accounts? How does that work?
Yeah, so we are definitely the beneficiary, having been in the industry since essentially the dawn of the industry, to be able to get a name like that is so closely tied to the product. Really, what prior to the existence of HSAs came in and were enacted in January 1st, 2004. Prior to that, they were really structured in something similar as a pilot program that was launched in the mid-90s called medical savings accounts, or MSAs. So I'll be honest, originally we started as MSA Bank.
Oh, okay.
And at that time, all we did was focus on MSAs. And then, of course, when HSAs came into existence in 2004, we rebranded to HSA Bank. And then, probably about a decade ago, we started introducing other consumer-directed healthcare accounts administration into our repertoire. So we started serving, for instance, flexible spending arrangements or accounts, health reimbursement arrangements, started doing COBRA administration, and really anything associated with the account-based health plan administration as really an offshoot to our HSAs. I'll be honest, HSAs are still our primary product and by far the lion's share of what we serve today. We serve more than 3 million customers, for instance, just for HSAs. But, so we never forgot our roots from that standpoint. It's definitely our focus, but we do actually sell more than HSAs today.
Okay, so you are the only HSA bank.
Yes, so there are other administrators in the HSA industry that might be a bank. However, there is only one HSA Bank, and that's obviously a trademark that we own.
Okay, well, we are honored to have you here with us. So this is a double-sided question. How are they related to retirement issues, and how do HSAs work with Medicare? Yeah,
so excellent questions. I'm going to take the first one. Really, how they relate to retirement is really they are probably, I would argue, the most powerful way to save and spend for health spending needs throughout your life. If you stop and think about it, because of that triple tax advantage that I had described,
right.
There's really no better way to be able to save and spend for your healthcare needs. When you also take into consideration that, throughout our lifetime and what I'll call our life cycles, our specific needs around healthcare spending and savings are going to change, right? So if you stop and think about, turn back the clock, maybe when I was a young new professional, kind of young invincible, whatever you want to call it, I probably didn't have many healthcare spending needs, right? Maybe after I got married, maybe immediately there wasn't a need or a different need other than the fact that you now had a spouse to take into consideration. But then eventually, maybe you started a family, and at that point, if you hadn't already, your healthcare spending is going to change.
Yes, it is.
And you have to, think and act for the long run in that process, and thinking through, hey, how are my needs going to potentially change? And as we know, because time value of money and, the availability of our, earning years versus our earning years, and income versus expense, the earlier you start saving and the more you put away for future needs, the more powerful it's going to be. Then starting to, again, the next evolution of life, again, maybe my children are no longer young, maybe they're heading off to college, starting their own family, so on and so forth. Well, then I kick into retirement preparation mode, right? And it's probably a catch-up period for a lot of people, like, oh, maybe I didn't put enough away. Well, again, recognizing that the lion's share of your healthcare spending needs are actually going to be incurred during your retirement years, and recognizing the hundreds of thousands of dollars of assets that I might need just for healthcare in retirement. Again, HSAs play a critical role to be able to help stretch that healthcare dollar further and afford those expenditures. So again, I think HSAs can play a really critical role in a person's preparation for retirement, simultaneous to helping them be prepared for the current iterations of spending and savings that happen throughout our lifetimes, because again, it's going to change.
It is.
So that answers hopefully your first question regarding, let's say, thinking about HSAs in retirement. I think the second question was implications to somebody that may be, for instance, in retirement, on Medicare, on Social Security, whatever it may be. So there, HSAs have, again, a tremendous role to potentially play. Remember, I had talked about their ability to be used for qualified medical expenses. Well, what might surprise a lot of people are what are qualified medical expenses. Of course, most people are aware of, like, okay, I have a prescription. I go to the doctor and I have to pay for the doctor visit. I have an injury. I have to go to the emergency room. And that's your typical logic around what qualified medical expenses are. However, the IRS definition of what's a qualified medical expense actually goes significantly beyond that. For example, anybody that was paying Medicare premiums. So Medicare, obviously, currently, Medicare A does not have a premium, but let's say, for instance, I'm on Part B or D and D. Those are going to carry premium costs each month. Well, one of the things that I can use my HSA dollars for as a qualified medical expense is to pay for those premiums on a pre-tax basis. In other words, I get to stretch my healthcare dollar further because I'm paying for those expenses on a tax advantage basis. And considering, you stop and think about somebody that might be paying Medicare premiums for not just months or years, but even decades.
Oh, yeah.
Retirement. Having that option to be able to pay for those expenses at that time on a tax advantage basis is hugely powerful, right?
Right.
Another important attribute that would be really helpful to a person in retirement or potentially on Social Security is, remember I talked about the lifetime of healthcare spending and saving that people are naturally going to occur. One of the unique powers of an HSA, and one of the very significant differences between an HSA and some of those other products I was talking about, like FSAs and HRAs that probably more people are familiar with, those have a finite time frame where you have to seek reimbursement. They typically follow the calendar year. Okay.
Right.
HSAs are not that case. There is no time horizon by which when you have to reimburse yourself for those expenses. So again, another powerful attribute of HSA again, thinking about how you can apply this well into retirement and retirement preparation is I could, as I go throughout my lifetime, I might save up thousands of dollars of expense per year and do so over a period of, again, decades. If I wanted to, I could save up all of those expenses that I may have been paying for with a different form of payment. I save up all of those expenses. I can reimburse myself at any point in the future, and I can do so all at once if I wanted to. So if I wanted to save up, let's just say I had, I don't know, say $5,000 of expense per year on average, right? And I was going to do that over, the next, say 20 years. I could actually take $60,000 if I wanted to. I could take all of that all at once at a reimbursement, tax-free at some point in my retirement. I could do it all at once. I could do it a little bit here or there. There's no implications at that point to my income. Remember, because at this point, I'm just taking a pre-tax reimbursement, right? There's no ramifications whatsoever to me, and there's no time restriction for that as well, too. So it's something to think about. Again, the adaptability and flexibility and longevity of an HSA is really unmatched in the health spending and savings arena.
So that confuses me. If you're able to add those all up, did you have to have your HSA set up before you incurred those costs?
Again, if I'm covered by an HSA health plan, right? So the requirements to contribute money to an HSA are very, very simple. I first have to be qualified. I have to be covered by a qualified health plan, one of those high deductible health plans. And when I'm putting money in, I cannot simultaneously be enrolled in any other health care coverage that would afford those premiums, or not premiums, those expenses being paid prior to my deductible. I cannot be enrolled in Medicare, and I cannot be claimed as a person on somebody as a tax dependent on somebody else's taxes. If I can meet those four requirements, I can contribute money to an HSA. Once the money is in the HSA, though, there's no restrictions on what type of plan I have to have. There's no restriction on when I take reimbursements. There's no restriction. So the restrictions around an HSA are really on how to get new money into the account, not necessarily how or when to use those on distribution. So that's a really great question. So for instance, I'll just use my own personal experience. So every year I have 3 kids and I have a special needs child. So needless to say, I spend a lot. I spend a lot on healthcare every year because I know no matter what I do, even if I just go through normal life and nobody gets sick or hurt and has to go to the doctor, I know I'm going to have 32 office visits and 36 prescriptions every single year, no matter what, because that's how many doctor visits I know my special needs child and prescriptions they're going to have. They're going to have that whether I do anything, right? So I hit typically my maximum, I hit my deductible, my maximum out of pocket every single year. And so I'm going to spend, and I'm just for a nice round numbers, let's just call it $5,000. Okay. I know that I'm going to spend $5,000 a year regardless. I can contribute at least $5,000. Now, if you can contribute up to the maximum limit in 2022, the maximum contribution limit for somebody on a family HDHP is $7,300, right? And then if you're age 55 and above, you can put an extra $1,000 catch-up contribution in. So if I'm on a family plan, I can put in $7,300 plus another $1,000. And then if my spouse is also age 55, they could also put in another $1,000 into an HSA as well too. But let's just ignore that for a minute and let's just still stay with the $5,000. If I were to again have that same $5,000 of expense, and I was to have that same $5,000 of expense for the next, we'll say 20 years, that would be $100,000 that I have incurred expense, right? If I pay for those expenses on another form of payment, I save those receipts, and I can keep that in imagine if you had a shoebox with all of the receipts, and I save up all of those receipts. when I enter into retirement or any time thereafter, I could take $100,000. I could take it in a lump sum. I could take it a little bit. I could spread it however I want. I could take $100,000 at any point as a tax-free reimbursement to myself for those expenses.
That wouldn't count as income?
Nope, because again, it's a reimbursement for expense that I've already paid, and it wouldn't matter at that point. Remember, there's no restrictions on how I use the money on the back end in terms of health plan and so on and so forth. If I'm reimbursing myself for a medical expense, even one that happened decades before that, there's no ramifications to me from income. There's no requirements for age, for health plan or any of that stuff. Quite honestly, I could be on Medicare or not. It doesn't really have any bearing on me whatsoever.
Well, but you mentioned, and maybe I misunderstood, that you can't be on Medicare. There's something about.
Yep, that's the only for the qualifications of putting new money into the account.
So I went on Medicare a couple years ago. So I would have had to have set up the HSA prior.
Correct.
Okay,
yes.
so this is a big notice out there to our listeners to set this up when you're younger, right?
Yes. Yes. So as soon as you go on, well, presuming that you were to stay on Medicare, right? As soon as you were enter into Medicare, which for most Americans today, or the vast majority of Americans, that happens generally the month that you turn 65 in a traditional sense, right? Again, there's many Americans are actually not enrolling in Medicare at age 65 and actually pushing that out. I'll talk about some ramifications there because I think there's a couple of nuances that your listeners should actually really be aware of. But generally speaking, once you go on Medicare, you're probably going to stay on Medicare, at which point, as soon as you're eligible to have claims actually paid on your behalf by Medicare, your ability to contribute to an HSA would cease. So you're right. This is definitely something you don't want to wait on. If you are interested in learning about how to take advantage of an HSA, it's definitely one of those you do not want to wait on.
Because I know I've heard that you cannot, it's not the high deductible. Well, darn it.
Now, I will tell you that there are efforts within legislative arenas in Washington, D.C. to actually introduce option within Medicare, either through traditional Medicare or Medicare Advantage, to actually allow for HSA contributions. There's also Representative Ami Bera and Jason Smith. Ami Bera is a Democrat from Sacramento, and Jason Smith is Republican, Missouri. They actually jointly sponsored in each of the last two Congresses a bill that was seeking allowing any Medicare enrollee the option of contributing to an HSA. Again, it's like most bills, they haven't gone anywhere yet, but I would say that there's it's getting a lot of attention from both aisles, both sides of Congress, and I'm hopeful that we'll see something like that in the future, or at least allowing working seniors that, for instance, may only be on Medicare A because it was tied to their beginning of collection of Social Security retirement income benefits, the ability to continue to contribute. So neither one of those provisions is currently law yet, but let's keep our fingers crossed, because I think it's definitely something that will help seniors and really anyone on Medicare, again, stretch those healthcare dollars further.
And on the other side of that, with all this triple tax benefit, do you hear any rumors about anyone wanting to do away with that? Seems like.
Yeah, no, I could absolutely see that as a counterpoint. No, there's quite honestly, there's more than 30 million Americans today that are actively own HSAs. And then if you stop and think about, most HSAs are used for the benefit of more than one person. For instance, myself, in my case, I have my wife and 3 children that I could use my HSA for. So even though we only have one HSA in the house, it affects 5 Americans, right? So if you were to take the estimates are right around 33 million HSAs in existence, and multiply that times, I think there's, about 2.1 or 2.2 people per household, somewhere in that range. It's probably impacting about 70 million Americans. So I would say, while there's no guarantees that nothing will ever happen to HSAs, I think if you tried to take something away from 70 million Americans,
That's like, it's like Social Security and Medicare. It's not
Yeah,
gonna, we're not gonna allow it.
correct. There's too many people that have them. There's too many people that rely on them to have something completely take them
Yeah.
away. And to tell you the truth, I think not that anything couldn't happen. Quite honestly, I've not seen any, recent legislative efforts to try and do away with HSAs. In fact, at every step of the way, if you look at the Affordable Care Act, if you look at, provisions that have been enacted, since the Affordable Care Act, and even if you look to elements of the pandemic response acts and all of the stimulus bills that have been put in there. There have been actually provisions seeking to expand
Yeah.
the use of HSA or the flexibility of the use of HSAs there. So I don't think there's never any no risk associated with something like that. But I would say that there's very little risk of that. And if you look at the background of American tax law, never has there ever been a tax change that has taken something away, right? So it's not like they're going to invalidate. They may stop it moving forward, but they'll never take that benefit away once the money's in there. That's not how the government works.
So how young should pre-retirees be doing this? Is this something you should start when you're in your 20s?
Yeah. So like I said at kind of the onset of the call, the very best time to start is now. Right? Because time value of money, the earlier you start, the higher the balance is going to grow, the more time that you have on your side, the more contributions that you have, the time to put them in and build and invest in and earn returns on, and so on and so forth. Now, with that being said, I understand that many people have not had the ability or weren't aware of the opportunity of taking HSAs. It's not like you started on your first job at age 18 and boom, you knew this stuff, right? So
Yeah.
I would say it's really available to anyone of any age up until the point again, as we talked about, when you enter into Medicare. So even if you're 25 or 45 or 55, I think you still obviously have an advantage. The reality, though, is that the people that are 25 have a much longer time horizon and likely have an ability to grow a balance much larger than, for instance, somebody that would be 55, just because of the time horizon they have of contributions. But even take, for instance, that age 55-year-old. If, let's say, they were to go on to Medicare at the traditional age 65, they have 10 years worth of runway. If they're on a family plan, and generally speaking, the contribution limits get ratcheted up anywhere between $50, $100 per year. Plus, they're allowed to take care of a catch-up contribution. And if you were to again take the family contribution limit, plus we'll just say the anticipated increases in those benefits or those contribution limits over the next 10 years, plus a catch-up contribution for each one of the spouses, it's nearing $10,000 that you could put away into an HSA every single year. Even on a 10-year time horizon, that's $100,000. Recognizing that, would I want an opportunity to enter into retirement with an extra $100,000 that is tax advantage for healthcare? Oh, yes, please. I'll take that.
Yeah. Well,
So it's never too late to start.
I get that now. And how can one use one of these HSAs to build more savings through self-directed investment options? Is there anything on that side of it?
Yes, so definitely one of the advantages to an HSA is that it's not just a savings vehicle, meaning that I don't just have to put it in the bank account and forget that it's there, right? I can actively invest, and potentially any returns that are in that account can again be used for my benefit as a tax qualified distribution for Medicare or for medical expenses, right? And absolutely, that's the most powerful way of using it. But one of the things that I encourage people to do, if you stop and think about it, if I have an ability to put money away on a tax-free basis and earn income returns on that money and build up a balance on a tax-deferred basis, even if my advantages stopped there, right, it would look very much like an IRA. Right? At that point, it would effectively be the same thing. I can put money away on a tax-free basis. I can save it for future, and I do so on a tax-deferred basis. If I were to then take the money out in a future point, like in an IRA, I have to pay current income tax on that. However, this is the power of an HSA. HSAs go one step further than that because, again, if I'm using that money, if I end up using that money in my retirement for just to supplement my retirement income, it's the same darn thing that you would have had with an IRA. However, there was no income restrictions on it, and there's no required minimum distributions from it like you would with an IRA. Even then, it would be more advantageous or potentially advantageous than an IRA contribution. But then the power comes in, well, if I do use it for a healthcare expense, now I get that triple tax advantage. So it's no worse off than you were with an IRA contribution, for instance, and it's actually more powerful because it's triple tax advantage. Similar circumstance comparing it to, for instance, a Roth, right? The Roth, you're making the contribution with after-tax dollars, right? So you don't get the contribution deduction on the front end, but you get the advantage of earnings while you're growing the balance, and then obviously the distributions in the back end are tax-free. So it's, IRAs and Roth IRAs very powerful, but they're only double tax advantages either on the front end or the back end, right? HSAs have that potential to be that triple tax advantage. So it really is unique in planning, and it's something to be considered, as a way to, again, plan for my healthcare spending. And if nothing else, it becomes a supplement to my retirement income.
Right. And you just pay taxes on it. So do people that have these accounts in your bank, do they generally work with another bank, or is the HSA Bank their bank?
Yeah, so the bank in HSA Bank serves as kind of the record keeper for all the ins and outs. And then, of course, if you were to have transactions, whether you're taking an online reimbursement or doing, mobile transaction, or if you're swiping a debit card or those types of things, of course, we have to do all the normal functions that you would see in a normal, debit account. But then we also offer investments, and we offer investments with close partnerships with several different entities. And we offer, for instance, no load mutual funds that are configured in a setup that looks very similar to a 401k, where you've got a menu of selections, choices at cross section and sectors to choose from, and so on and so forth. And then we also have connection to TD Ameritrade and offering a self-directed brokerage account. And once you're over on the TDA side, quite honestly, you can purchase anything that would be allowed for HSA investments. So if you want to buy individual stocks and bonds, if you wanted to buy mutual funds, if you wanted ETFs, whatever you wanted to buy, you can get to, last time I looked, it's hundreds of thousands of options, because again, you have all your individual stocks and bonds plus something like 13,000 mutual funds. There's more than 2,600 that are no transaction fee funds. I mean, there's almost limitless options that you would have at your disposal. We find most people, if somebody's looking for a very specific investment, or they want to put it into individual equities, that's the way those people go. The other people that are maybe not quite as, they're not as adventurous, or maybe they're just looking for the easy button. They just want to have a nice, setup, or maybe they're using target date funds or fund of funds or whatever it may be, and they just kind of set it on kind of that autopilot concept, if you will. That appeals to a different type of audience. So we offer multiple options. We actually even have a third option that potentially allows the connection to financial advisors, for the financial advisor to be able to help you in various ways as well too. So we have several different flavors. Quite honestly, we encourage people to think and act for the long run, and that includes not only contributing money to the account, but also thinking about their future needs and planning and using some of those dollars to invest. Most people don't put all of their HSA money in investments. They probably leave a certain amount as we'll just say as a safety net of liquid funds they could access, right away. We highly encourage that. But again, recognizing that most Americans potentially could need hundreds of thousands of dollars in their retirement for their healthcare needs, really, the only way that you're probably going to be able to chip away at that fully is to invest, right? Because we all know that as a bank, we're limited to FDIC insured accounts. You're not going to see stock market type returns. Of course, you won't see stock market type risk associated with that. But again, we're going to be very traditionalist in terms of bank rate of return, which is great for that safety net portion. But we encourage people to think long term and invest some of their HSA assets for the long haul, and probably do so with investments.
So I guess just on the larger scheme of Social Security and retirement planning, can you explain how HSAs fit within that?
Great question. I would say that what you have to look at is, HSAs work really well in the contribution components. If you're going to have somebody that's going to go on Medicare, they're very powerful for contributing. But once you go into Medicare, obviously you have to cease contributions. And then it really becomes a question around healthcare spending and decumulation. I think that most Americans would inherently know that, hey, the core tenet of retirement savings is socking money away at a regular interval, saving for the future. And I think there's a lot of thought and efforts that go into the accumulation phase of retirement. But retirement spending doesn't end. And retirement planning doesn't end when we enter into retirement.
No.
It just changes a context, right? At that point, maybe it's less about the accumulation of assets and now about the decumulation of assets. And that's really where I think people need to spend a little bit of time thinking about not just what their income needs are today, but where their income needs and what constitutes their income needs in those future years. For instance, historically, if you were to look at least on the average, your need around healthcare spending is going to go up as you age. In other words, as we get older and older, the propensity for us to actually need healthcare services and the cost of those expenses go up, right? So one of the interesting thought processes that should enter all retirees' minds is, hey, I've reached the pinnacle. I've entered into retirement. I pushed the rock up the hill. Great. But don't stop thinking about, well, what is that runway going to look like in the next 5, 10, 15, 20 years? I mean, Americans are living longer and longer, and the need to stretch those healthcare and all retirement dollars out further is of great need. For example, I mentioned one of the powerful attributes of an HSA is to pay for Medicare premiums as a qualified distribution, right? Very great way to stretch those healthcare dollars. But again, whether I elect to do that at the time that I incur the expense, just like we were saving up those receipts for future use, just because I'm paying Medicare premiums today, if I elect to do it under, and let's say, for instance, I'm using, probably the way most of them are being paid is it's just being taken out of their Social Security, right? I mean, that's the way most of the premiums are being collected. So I could each month go into my HSA and set up a reimbursement for those directly to me. And I'm going to be taking that at distribution every single month. Do I want to do that? Maybe, maybe not, because again, I could save that expenditure for a future time, right? And maybe I want to be able to do that at some point later in my life. Or maybe if I'm a really nice person, I want to pass, because if I were to die with an HSA balance, that's going to become, unless you're passing it to a spouse, if I was passing it on to my children, for instance, if it has not been used for qualified medical expenses, it's going to be reported as income in the year they receive it, right? Just like any other retirement asset. However, if I would have saved up all those healthcare receipts and all those premium reimbursements that I could do, I could pass that on to them on a tax-free basis if I wanted to, right?
Really?
Yes, because I would have saved up all those receipts. So again, I'm not advocating that you want to do this in every circumstance, and you might need, if you're living kind of, security check to security check, you may need to take that reimbursement. You may need to stretch that healthcare dollar. But the point is HSAs afford that as an option to you.
Right. Do they pay for long-term care?
Yes, you can. You can actually use, there's qualifications around the use of HSA dollars for long-term care. Essentially, it has to meet the IRS definition and so on and so forth. But yes, you can pay for long-term care, qualified long-term care premiums, and of course, related medical expenses. You can't use them for, like, for instance, if I went into a nursing facility and I was just paying for the normal cost of the services for daily living, right? That's not a qualified medical expense, right? But if it's associated with providing me healthcare services, they are. So there's a specific nuances there, and I would definitely talk to, look to the IRS publications, like for instance, IRS publication 502, and explain this. Talk to a elder care attorney or a tax professional, somebody that understands the nuances of what I'm talking about, before just making an assumption that, oh yeah, if it's long-term care, I can pay it or not with an HSA. And I would just caution people, yes, it can, but it has to meet certain criteria.
What should, there's so much to talk to you about. I think I might turn this into a continuing education course. What should employers know about HSA programs?
Yeah, so I think there's a great, I could talk for hours on that topic, but again, under the context of what I was talking about for retirement, and I would specifically say people aging into Medicare, right? I think that is a confusing, despite all the years that and the hundreds of thousands of people that it impacts every single year aging into Medicare, and actually it's really millions of people actually.
Yeah.
If you stop and think about it, that should be an easy transition because of how often it happens. Well, anybody that's ever gone through it, or anybody that's helped anybody go through it, it's anything but.
Yeah, for sure.
It can be really confusing. So give you example, just understanding when am I going to be, if I'm on an HSA plan and I might be covered under my employer's health plan, when I age into Medicare, when should I stop contributing to my HSA, right? That's a very common question that would, every single person that meets that criteria is going to be faced with that. Well, just understanding, because as you know, eligibility to enroll in Medicare starts essentially 6 months before I turn 65, right? So there's a lot of confusion out there that, for instance, when people actually complete the process to actually enroll, they're like, oh, I got to stop contributing to my HSA. No, actually, it doesn't. You don't have to stop contributing to your HSA until your coverage actually begins, until you're entitled to have claims actually paid on your behalf, which again, for most enrollees would be the month that I turn 65 in a traditional Medicare enrollment window.
Right.
That's when I have to contribute. So for instance, my birthday is in June, right? So, and when I go on Medicare, presumably if I were to, follow the traditional age 65 enrollment, my coverage would start June 1st of the year I turn 65. Well, for the 5 months leading up to that, January through May, if I was, otherwise qualified to put money in an HSA, I actually can contribute for those 5 months of the year. Right, so I can contribute 5/12 of the limit.
Well, and also if you're I'm sorry to interrupt you.
Oh, no, go ahead.
But if you're still going to work, like you mentioned earlier, you get that one little exception with Medicare, and you still are covered by an employer plan until you lose that. And you want to be real careful because of the penalties, but so you can still contribute, right?
Yes, because so that's a common scenario that you're seeing more and more people that are opting, or maybe they have to keep working past age 65, right? And maybe, for instance, they don't want to go on to Medicare. Unfortunately, if they were to currently, if they were to apply for Social Security benefits, one of the nuances of Social Security enrollment, and it's been like this since the early 80s, is a matter of just process within the government. Once you start taking Social Security retirement income benefits, they automatically enroll you in Medicare Part A, right? So if that happens, whether you're still covered by your health plan at work, if you're covered by Medicare A, once that were to happen, that would indeed stop my ability to contribute. But what we're seeing more and more people doing today is actually saying, I don't want to take Social Security benefits. I want to maximize my contribution or my income for Social Security. I'm working anyways. I'm getting employer benefits. So what we're seeing more people do is say, I don't want to take Social Security. I'm going to defer it, right? I'm not going to take Medicare. I'm going to stay on my employer's health plan. And it might be 67, 68, 70, whatever age that you would want to. In that case, you can absolutely still keep contributing to HSAs. But even then, there's a little nuance, right? So it has to do with retroactive Medicare coverage. And again, this is a little nuance of if you were to actually defer taking Medicare and then enroll at a later date. One of the nuances that is not really well known or understood is that they will make your coverage retroactive 6 months. What you would have to remember at that point is if you were in that scenario and you have deferred to start Social Security and deferred to start Medicare, you would need to stop contributing to your HSA 6 months before you actually did go on to Medicare because they're going to make it retroactive. Or if you found yourself in that circumstance where they made it retroactive, you're going to want to call your administrator if you've been continuing to make HSA contributions and take those contributions out at that point, or at least make sure that you haven't exceeded the pro rata amount that you can contribute for that given year. So again, these are weird nuances, right? Probably, and back to your question of what can employers do to help people understand this, communicate, educate, and have them talk to, entities such as ourselves to help people understand these things. Because with more and more people working past age 65, more and more people, staying on company benefits and not taking Medicare and not taking Social Security age 65. These are little nuances that can help them and hurt them. And the more we can make people aware of these things, the more people we can educate people on these attributes, the better.
It's just like Social Security, but it just popped into my mind, and this is going to be my last comment because we're going up on against a long time here. But when you mentioned the 401ks or the IRAs, so I would encourage people who are still working and younger to contribute to an HSA in addition to those IRA. I mean, you have those RMDs and those get all tied up in the age 72 required distributions and the taxation of Social Security. And so I'm seeing the value here. And
you would never hear anybody, hopefully you would never hear anybody tell you that you should do one or the other.
Right.
Really, one of the core tenets of retirement preparation should be contribute as much as you possibly can to the best vehicles. And it might be all of the above.
Right.
And so if you have for instance, if you have a 401k at work or a 403b or whatever, maybe absolutely you should be considering making contributions, especially if you're getting matching contributions, right? Simultaneous to that, you should be also considering making contributions to HSAs or any other retirement entity vehicle that would be at your disposal. Obviously, probably the most tax advantaged is the HSA, right? And probably the most, we'll say the easiest is probably the 401k, just because you're probably doing it through payroll deduction directly from your paycheck and not even thinking about it, right? So encourage everybody to consider all options. The HSAs play a very powerful role, and they may not be for everybody, and they may not fit everybody's circumstances, but I encourage you to at least look at them.
Okay. Well, lastly, I don't want to leave it out. How can people reach you, learn more about HSAs, email, website, whatever you'd like to provide?
Yeah. The best resource is our website, which is simply hsabank.com. So the acronym for Health Savings Account, hsabank.com. And through there's a tremendous amount of resources if you'd like to learn more. There's educational resources. There's calculators that you can actually use to look at, well, is a high deductible health plan right for me? Well, if I have an HSA, how am I doing for retirement preparation? Contributing enough? We also have a very helpful health and wealth index calculator, which is the concept around the emergence of a convergence of health and financial well-being. Am I doing a good job in that range? So we have prepared a way to measure those results and give insights how to take action. So tremendous amount of resources at the disposal. You don't have to be a customer of ours to actually access those. And like I said, the best way to access those is through the website, and through there you can also click on the contact us or call us, and we can help you answer some of these questions for yourself.
Okay. Well, thank you so much for talking with us today, Kevin. That's it for today. Thank you for listening to our podcast. Please tune in every Wednesday for new episodes, and our expert guests share a wide variety of knowledge on all retirement planning aspects. See you next week.
Thank you.